Welcome to Plan B Trading. In this short segment we ask the question, what is a stop loss in trading? This video uses spread betting to show the process and outcome of taking a long trade or buying a currency. Terminology is used in this video which is explained by the frequently asked question, what is spread betting, at www.planbtrading.com. Before taking any trade, you want to assess all possible financial outcomes of that trade. That includes an expectation of buying price and selling price. It should also include another price, the price at which you will exit the trade if it is not going to plan. This price is known as the stop loss. Creating a stop loss or a stop loss order provides the broker with instructions to close the trade once the price reaches a pre-specified level, thus limiting the potential loss on a trade. As this is a predetermined order, it reduces or even eliminates the emotions often felt during trading. Let's run through an example. Suppose I am trading the Aussie dollar against the Japanese yen and I expect the exchange rate to rise. I can see the price at which I can buy and sell this currency, buy at 82.31 and sell at 82.27. Suppose I were to trade this currency long, that means buying, at £6 a pip. With the Japanese yen, a pip is the second decimal place. As I buy the currency, my position is shown along with the price I took the trade. My exit price is shown, which is the price I can currently sell at. A running profit and loss is shown too. Let's watch this as the price changes. I'm not going to set the stop loss as I'll watch the trade progress and I can close the trade manually if I need to. Anyway, this one's going to make a super profit. Notice as the price increases, my P&L position improves. Now the price has moved 4 pips, I'm breaking even. Each pip of price movement is worth £6 as that was my initial stake. As the price continues to move in my favour, the profit on the transaction grows. Sometimes the price retraces its steps. Nearly back to the starting point. I don't like the way this is shaping up. Time to close this trade. Oh, hang on, there's someone at the back door. Back in a moment. Wow, that moved quickly. What to do now? Shout at the screen? Come on, go back up. Can't go any lower, can it? I'll just hold on and maybe it will go back up. This is getting expensive now. I can't keep this going much longer. If it gets back up to 81.81, I'll sell it and restrict my losses. At this point, have-a-go traders are usually uttering 4-letter words in abundance, so let's try it. Ouch, ouch, ouch. You might have your own different 4-letter words. You don't need to share them with me. Anyway, I'm out. It's too painful now. What do you reckon? It'll go back up now, eh? A quick comment before the trade analysis. You've just seen the wrong way to trade. If this is how you trade, stop trading now before you lose any more money. Let's run through the trade. The trade was closed for 71 pips of loss, the price having fallen after buying the currency. At a stake of £6 a pip, the loss is £426, which is £6 multiplied by each of the 71 pips. By closing the trade with a manual intervention, we have effectively applied a stop loss, a decision to stop any further losses accruing. It was very hit and miss though. The price deteriorated quite quickly whilst away from the screen. Closing the trade in this random way was a very emotional experience. How much money to lose now? More or less? Hardly a professional way of trading or making rational decisions. What would have happened if the trade was not closed? Well, it was the 23rd of August 2012 when I started producing this video. 9 trading days later, we would be looking at closing this below 79.81, a loss of 250 pips or £1,500. One of the emotional aspects of trading is how we like to be right. In this case, we console ourselves that we made the right decision by taking a loss of £426 rather than £1,500. As a trader, we got it right again. On to the next trade. It won't be long before there's no money left in the trading account at this rate though. Far better would be a stop loss order associated with the trade. This instructs the broker when to close the trade. If a stop loss order had been placed at a level of say 82.01, the loss on this trade would have been limited to 30 pips. 82.31 minus 82.01. It would not matter what I was doing, whether I was at my computer or not. The broker would automatically close this trade as soon as the price dropped to 82.01. I'd perhaps return later and be disappointed with the £180 loss this would have meant, but there would not have been the emotional roller coaster and heavier loss of £426, along with the resultant dent in confidence. Until I realised I was right, 426 was better than 1500. If you take larger than expected losses while trading, or if trades only produce a small profit, do you look for ways to convince yourself you were right? If so, or if you still have questions, call 0203 603 4983 and talk to a trader now. You'll learn to calculate where stop losses should be placed and how to place and manage stop loss orders when you attend Trading 101, our entry-level course. Book your place on Trading 101 or have a chat with one of our traders by calling 0203 603 4983 now. You can find more information about coaching and our training programs, and you can book online at www.planbtrading.com.